Hey everyone, welcome to our final seminar on oil and gas accounting. This one will be centered around reserve reports and how to understand them, read them, and test them. There's a lot of oil and gas lingo and jargon within here, so make sure you go back and watch the first episode where we go over many of those acronyms. This training was originally meant for auditors, but can be used by management for understanding and testing of their own reserves, so keep that perspective in mind as you follow along. If you learned something new, please like, share, and subscribe.
So this afternoon we're going to do oil and gas reserves testing, and this is a pretty important piece of oil and gas audit, so that will kick it off. So we're going to do a few things today. We're going to go through kind of what oil and gas reserves are. We're going to do some reserves testing and PCAOB inspection kind of results and observations that they've had over the years, some planning discussions for reserve reports, summary testing, high-level testing, some reminders how to sample for reserve report testing, detailed testing for third-party reserve reports, detailed testing for internal reserve reports, and then some SEC regulations and comment letters that have been received over the years. So kind of oil and gas reserves from a high level, the way I kind of like to explain this is if you think about a company's oil and gas reserves as like a glass of water. So like within that glass, it starts off as full, right? Then you put a straw in that glass and start taking some drinks out of it. And as you do, the volume in there declines. It's kind of the same philosophy if you think about it. You have a pool or a reservoir in the ground. You put a well in the top and you start pumping out. Over time, you lose the volume of reserves within there. There's kind of three different main categories of what we call proved reserves. Those are proved developed producing, proved developed non-producing, and proved undeveloped reserves. And the key thing with those is each one is an increasing level of risk associated with them. So proved developed producing reserves are reserves that we know are there and are currently producing. So those have essentially a 100% chance of being there. We know they're there, they're currently producing. Proved developed non-producing is the same reserves, they're proved, generally related to a proved developed property, but there's something wrong with them where they're not producing at the moment. But generally the key distinction there is that it takes minimal capital investment to get the reserves back producing again. And then the last category is proved undeveloped properties. Now those are proved properties, so they have greater than 90% chance of being there. However, we haven't put in any of the infrastructure to actually access those reserves yet. So for example, the wells haven't been drilled. We haven't done any of the completion work. We just believe that, and with a greater than 90% certainty, that those reserves are there. Now, continuing on with increasing risk is what we call non-proved reserves or unproved reserves. We have probable and possible reserves. So probable reserves are generally interpreted to be around a 50% chance of being there. And then possible could be anything over 10% chance. We don't typically factor in too much for probables and possibles for accounting purposes, other than maybe some for an impairment on a successful efforts company. And the other thing that's key to kind of understanding the concept is reserves also have to be commercial. And what that means is it has to be profitable to pull those reserves out. So like I could have reserves that I know are down there, but it could cost me so much to get those reserves out that I would lose money from the start. And if that's the case, then those reserves aren't commercial and I wouldn't want to develop those reserves, right? So to be considered oil and gas reserves and proved reserves, they have to be both more likely than 90% recoverable and commercial. So go to the next slide. So this is kind of what we just talked about. So it has to be discovered, recoverable, commercial, and remaining. Those are kind of the four criteria. And then they're categorized in accordance with their risk criteria. And you can see here this chart provides kind of a good sort of, I guess, kind of graphical representation of the different reserve categories. So the first piece you can see everything that's improved, probable, or possible is considered commercial. and then they're at increasing levels of risk, and sub-commercial would be considered unrecoverable reserves. So these are kind of some different things that are looked at from an engineering standpoint as to how they determine reserves. Generally, they're maintained in various rock formations and sand formations. So one of the big pieces is the porosity of those formations, which will allow the oil and gas to get to the well and be pumped out. Then permeability, same sort of concept. Gas to liquids ratio. Some wells will be very gas heavy, and then some wells will be more oil heavy. So it can affect kind of the overall commercial viability of those reserves generally, because oil obviously is a little more expensive than gas right now. And then the other thing is oil is not all made equal. There's various differences in product quality and the characteristics of oil. Like for example, like oil in the Permian is generally kind of more valuable than like South Texas oil just because it's heavier. So well logs, they'll look at wells kind of in similar areas to how those are produced. Seismic data, they'll look at kind of the data behind the formations underneath the ground, how to interpret those. And then decline curves is a measure of how fast we expect the reserves to decline as we pump them out. Typically, reserves will decline a lot more quickly in the beginning than they will towards the end. And that's kind of a function of pressure. Like if you think about it, if you poke a hole in a balloon, the pressure comes out really quick, and then there'll be kind of some leftover stuff at the bottom, which will go out a lot slower, obviously. And then feasibility assumptions, that kind of factors in the commercial aspect of it. Is it feasible for me to access these reserves? Recovery techniques, what am I going to have to do to access this oil? Do I have to force pressure down back into the ground using natural gas or water floods or something like that? Those will be more expensive than if I am accessing a new field that still has its pressure. From an economic standpoint, for SEC pricing, we use 12-month average pricing, which is historical. And then we'll look at historical lifting costs. We'll look at the future development costs, what we think it's going to take to actually access those proved undeveloped reserves. We'll look at what we're going to have to pay out in the future to abandon or claim those reserves. And then we'll look at what we're going to have to pay out for production and severance taxes. From a transactional standpoint, we'll look at historical production volumes, what wells kind of similar to the ones we're looking at have produced, what our wells that we're calculating reserves on have produced historically, and factor those into the decline curves. We have division orders, title opinions that will impact what we have, what percentage of the well we own. For example, if we can recognize 80% of the revenue or only 50% of the revenue, obviously impacts the commercial viability. Some curtailments or shut-ins. Shut-ins would generally lead to a proved developed non-producing property. Curtailments and then net profits interests. So another thing that's always interesting is kind of where reserves are located in the U.S., right? In the U.S., there's kind of some main areas where we have oil and we have gas, and kind of some of both. Some areas have both. So kind of some of the most common plays and that you'll see in the U.S. are the Marcellus, which is up in the Pennsylvania area. That's almost exclusively natural gas. It's one of the highest producing gas areas of the country. Then we have the Delaware Basin, which is out near Midland. It's typically very oil heavy. It does have some natural gas production. Typically the natural gas is not the most profitable thing out there. In the Bakken area, it's very oil heavy. There is some natural gas, generally not as profitable. Transportation can be very expensive for Bakken area just because of the kind of the remote nature of that part of the country up in North Dakota. Powder River Basin is kind of out in sort of Wyoming, Colorado area. Has some oil and some gas reserves, kind of depending on which area of the Powder River you're in. The Eagle Ford is down in South Texas. It's very heavy oil reserves. The Denver Basin, commonly it's referred to as, you'll see it as the DJ Basin. And then the offshore kind of areas of Texas and Louisiana. The border of the U.S. is 200 miles out from the coastline. And then the area between the coast and the border is called the exclusive economic zone, where the U.S. has identified about 30 basins that contain oil and natural gas within our exclusive economic zone. Here's kind of some other maps kind of showing where various reserves are. You'll see in South Texas, there's a lot of, these are the oil heavy fields. So South Texas, you'll see a lot of oil. North Dakota, you see a lot of oil. And then the Midland Permian area, you see a lot of oil. And then here we have kind of the gas fields. So these, you'll see the Marcellus up there towards Pennsylvania, Ohio, West Virginia, very gas heavy. And then you'll see some gas in central Texas and then up in Wyoming and Colorado. So from an accounting standpoint, reserves are really important because they impact kind of a lot of different accounting areas. Those are asset retirement obligations, DD&A, ceiling tests, impairment tests, taxes, imbalances. ARO, primarily we're looking at the well lives and when we expect in the future to have to plug those wells. DD&A, it obviously provides our depletable base. The full cost ceiling test, it provides our PV10, which provides our ceiling, an impairment test for successful efforts, and then taxes we look at especially as well. It's a very important area of an oil and gas company because it affects so many different areas of the financials. So some quick PCAOB comments. We've gotten the detailed basis reserve testing. We needed to enhance testing of data provided to the reserve engineer. It's not sufficient to only test from observer report back to the company records. So the main thing there is that we have to also audit the work that was sent from the company to the reserve engineer. So make sure that they were providing complete and accurate data to the reserve engineer for use in their calculations. And then summary basis reserve testing. We need to enhance testing of summary reserve report, including the completeness assertion, and then testing surrounding acquisition reserve reports. This can be a really tough thing to audit because it's hard to find kind of comparable information. But that being said, it still has a big impact kind of on the financial statement. So it's something we need to really look closely at and perform a high-level review for reasonableness and do detailed testing as well. Some recent other inspection findings. We need to set expectations, demonstrate how they're developed, evaluate the precision of the expectation, and then consider barrel and MCF variances as a percentage change rather than just a volume change. Then when we're documenting variance explanations, we need to explain the reasonableness in addressing the variance identified. We need to obtain corroborative evidence for explanation provided, so don't just take management at their word. If they tell you that LOE per BOE decreased as a result of less compression costs, we need to go make sure that they actually did spend less on the compression costs, and that can be justified. Future development costs, it's generally a good thing to look at it on a per well basis. You want to include consideration of well level estimates in the detailed reserve report testing. And then the key thing here is you want to make sure that there's a good basis for what those FDCs are being factored in at. So you want to compare their estimate to the authorization for expenditures, historical cost to drill, or other industry reports or kind of comparable type wells.
All right, now we're going to go over the reserve report planning discussions and the actual planning portion of our reserve report testing. So on this slide, I think the main takeaway here is we need to meet with management and the reserve engineers prior to the completion of the audit planning. So this is something that we need to do during planning prior to the completion. We need to get this started early. That way we don't have any surprises at year end when we're doing or completing our audit, and making sure that we have all the reserve reports we need to finish the audit. We need to discuss and document the entity's reserve reporting process. This will just be discussing who's doing the reserve report, Making sure we're getting the right reserve report that we need, that way there's no surprise at year end if, they need to run something different. We need to communicate with the reserve engineers and management that we need the full reserve report and not just the summary level or the one-liner. I think what happens a lot here is that, we're communicating with the accounting department a lot, and a lot of times all they use is the one-liner report to do their DD&A and impairment calculations. But for our purposes, we need the full report, including the cover letter that shows the pricing and inputs that are going into the reserve report, as well as all the summaries. We also need to inquire with any past reserve reporting issues and make sure those are being resolved and fixed from last year. I know a lot of times what usually happens is, they usually prepare the wrong reserve report, like we get a management best estimate reserve report when we need an SEC reserve report or vice versa. So, or, any errors they might have with, PUDs that are over 5 years on an SEC reserve report. Those are a lot of the errors you see. So we just need to discuss that with management and the reserve engineers to make sure we're going to be able to get what we need at year end, so there's no issues. All right. We also need to talk with the reserve engineers independently to make sure there's no undue pressure from management. Make sure management wasn't trying to, increase production or fluctuate the differentials any to increase reserves, because they might be in an impairment position and they're trying to reduce that impairment. So we just need to make sure that the reserves or the engineers weren't under any undue pressure, or they would have done anything different from what management had. All right, we also need to document who prepares the reserve report. Is it a third-party engineer that does it, or is it prepared internally? If it's a third-party engineer, obviously we need to document who the third party is. And we need to know exactly what they're doing. Are they doing a full-blown reserve report? Are they just going to be doing an audit of an internal reserve report? Or are they going to be doing a review for reasonableness of reserve report? So that's something we need to talk with management and the reserve engineers during the planning phase to make sure we know what's going on when we get to year end. Also to note, the company can internally produce a reserve report, and it's not required to have a third-party engineer prepare it. But a lot of times you usually see an internally prepared report will usually be audited by a third party most of the time. It doesn't have to, but that's usually what you see, or what I've seen in the past. We need to determine and document how the reserves are estimated. Are they using an analogy method based on analogous wells in the field, similar wells? Are they using a volumetric method based on total production in place and the amount that can be recovered? Performance curves, similar to a decline curve. Are they using historical production on a graph to show a production pattern? This is usually more accurate than an analogy or volumetric method. Or are they using a material balance analysis method that takes various inputs like production, pressure, temperature, and fluid analysis to determine the reserves in the ground? So we need to document all those. We also need to document how the reserve report is prepared during planning. Are they going to do a full-blown analysis, or is it just going to be a roll forward? Typically what you see during a year-end audit is they will do a full-blown reserve report analysis at year-end and use that for year-end, depletion and impairment purposes. Usually during quarterly reviews, you'll see a roll forward, which is just they take the production and pricing and roll the reserve report forward from year-end. That's usually what they do during quarterly reviews. But at year end, most of the time they'll do a full-blown reserve report. We also need to determine the client's process of developing differentials. Are they using the accounting LOS to develop these differentials? Are they using wellhead volume information? What pricing they're using? There's there's various inputs that can kind of go in this differential to know how it's calculated. And this seems to be a question that comes up quite often when we're doing our reserve report testing is, a difference in differentials. They might have used actuals or wellhead information and different pricing compared to what we were using. So we just need to be on the same page going into the audit, how they're determining these differentials. We need to know the method of data transfer. I think this is a point that's been harped on in the last few years is, does a third-party engineer get the information out of the client system, or does the client prepare the information and give it to the third-party engineers? We also need to make sure that we're auditing that information directly from the third-party engineers, not just the information out of the accounting system. So that's something we need to determine during the planning phase. We also need to document the level of management's involvement in the third-party reserve report process. Once they produce the initial reserve report, we need to get with the reserve engineers and document, what questions the management have, what tweaks do they want to make, any changes, things like that. And this is good for, we can use this for our risk assessment process to determine, what is management looking at, what are they trying to change, what was the big issue with them, things like that. We also need to document what process management is using to review the reserve report, who's reviewing it, what are they reviewing, what questions they ask, and who's signing off on this reserve report. Let's move on to the summary level testing. So I think, the main thing on this summary level testing, this is basically where we're going to start our reserve report testing at year end when we're doing our field work or audit work. We need to start this process as early as possible, just because reserve report testing is not something that's going to get done in a day or even a week. There's a lot of people involved with this. It's, you're talking to reserve engineers, you're talking to accounting, you're talking to management. Everybody has different inputs. Different people are going to know the answers to different things. So we need to get this started and get our questions out, or start our analysis and get the questions out as soon as possible. That way the client has time to work on it. So when we start our summary testing, we'll perform various analysis. One of the first analysis you'll start looking at is the pricing analysis, where you'll compare the pricing that is used in the reserve report, and you can, like on an SEC reserve report, they'll use the last 12 months spot price as the first day of each month, which is SEC pricing. So you'll usually find that in the cover letter. It'll say, this is the pricing that we used and inputted in the reserve report. Then you'll then go out and find an independent source to gather your SEC pricing and compare that to the pricing they used. Usually, I don't find many issues with this. Every now and again, you'll find some variances just because, different reports are different, or a little different just due to timing and things like that. But most of the time, this should be pretty similar. And you can consider asking the engineer to run a prior year report using current year reserves. And then you can compare that to last year. So that'll give you an idea on, what changes, and that'll help with your analysis quite a bit. Another key thing to note here is feel free to go and ask the reserve engineer to run a new reserve report with different pricing. It usually doesn't take them that long. It's usually not that hard for them to do. So don't feel scared, to go out and say, hey, can you run a reserve report with, this different pricing? I'm trying to do an analysis like this, or I just, we're showing this differential. The company has this differential. Can you input this and see that way you can look at a difference and compare it to what they had calculated for DD&A and impairment. And that'll, see if you have a material difference in the reserve report. You can also perform a roll forward analysis. You can look at any significant changes in the company and any production, any additions and disposals to wells they've had. any revisions of estimates that they may have had during the year. And, they might have entered into a new play or a new field, and, that might explain, you've had PUDs really increase from last year. Well, they entered into a new basin in West Texas. They've drilled some wells there, and they've been very good. So the PUDs have gone up dramatically. So, explanations like that will help you in your analysis. We'll also perform a production volume analysis. You'll compare the estimated reserves. I think on here it says 2018, but we're just using these dates as an example. But like for this year, you'll compare the 2022 estimated reserves on the reserve report, and you'll compare them to the 2021 actuals, and make sure they're in line on an overall basis. Of course, you're going to see a decline, like if you're comparing PDPs to actual production. There generally will be a decline because of normal decline curves, but you'll as a team you'll be able to analyze whether that decline is reasonable or not. You also want to look at the NGLs, see if NGLs are included on the report, and you need to make sure who owns those NGLs, because a lot of times those NGLs are sold through the pipeline, and the company does not own those NGLs at that time. So we just need to make sure if the producer owns them, then they go on the reserve report. If the marketer owns them, leave them off the report. As I kind of talked about earlier, we need to look at pricing differential analysis. We need to determine how the client calculates this differential, what information they're using, what pricing they're using that's going in there. There's various different inputs that can go in this differential calculation. So we just need to look at that, calculate it on our own using our, independent pricing, look at the company's LOS, determine their actual differential and compare it to what the differential they're using in the reserve report. And we need to investigate any differences that are above our threshold. LOE analysis, this is pretty straightforward. We just compare the LOE for BOE in the reserve report to the actual LOE for BOE that we've been auditing. You'll generally take an LOS that's been audited or we are auditing at the time and, calculate the LOE for BOE and see if there's any differences and investigating variances. You need to take into account, a lot of times on the main thing on a reserve report is they'll use a fixed LOE rate and then bake in a variable rate. So they might chart or might say, this well's going to have $15,000 of LOE during the year plus another $2.50 of LOE for BOE on top of it. So a lot of times, you might see a difference in LOE for BOE, but you need to take into account, what they're using and how they're calculating it in the reserve report. Production curve analysis. Generally, production always declines over time. So we need to question anything that doesn't follow this rule. So we'll compare, we'll run decline curves and we'll run them on a chart, and we'll go over the summary level testing in an Excel workbook here in a little bit. But you'll just run a chart and look at a decline curve and make sure it's declining and it's consistent with prior year. A lot of times where you'll see increases in this is in PUDs and PDMPs for wells that have had capital input into them. So they have been recently drilled. So, of course, the production is going to increase with the new well being brought on. But you should see after those wells, generally like on a PUD, after the 5 years of capital expenditures, you should see a normal decline curve after that. We also needed to look at the discount rate analysis on our summary level testing. We need to make sure that the rate being used in the reserve report is being calculated throughout all years. Make sure the discount rate assumptions are reasonable. For an SEC case reserve report, it's going to be a 10% discount rate. That's SEC's rules. But like on a management best estimate report, they can use various discount rates. You might see 9, you might see 10, 11, 10 and a half. It just depends what management thinks is reasonable. But we need to document, why those rates are reasonable, even if it is 10%. why are they saying, it's 10%? Most of the time they just say it's, consistent with the SEC one. We think that's a reasonable rate to use for the company. So we need to do an analysis on the discount rates. And we also need to do an ARO analysis, compare the number of PDP and PDMP wells to what's on the ARO detail. You will have differences with this a lot of times, just because there are wells, there's usually older wells that become uneconomical during the year that fall off the reserve report just due to economics, but are still producing, and there's still a hole in the ground that needs to, the company is liable for plugging. So generally there's going to be more wells on the ARO detail than there will on the reserve report. So take that into consideration. We also do a capital cost analysis. This is just looking at the capital costs that are in the reserve report, usually around the PUDs, a little bit with the PDMPs. But we need to make sure the company has the capability to fund these capital expenditures. I've seen it before where a company has $100 million in capital expenditures for PUDs for 5 years, but they don't have the credit facility, they don't have cash on hand, they don't have the cash flow to actually fund those PUDs or those capital expenditures. So that's something we have to question and make sure that they're able to fund those expenditures on the reserve report. We also need to make sure that what's on the reserve report is consistent with what's budgeted. If they have $100 million of capital expenditures on the reserve report, but then we look at the minutes, they've signed off on, $50 million of budgeted capital for the year. Well, that's not consistent. We need to ask and inquire about that. We also need to look at, cost on a per well basis and compare those to AFEs that we've tested during the year. If you're, pull a sample for AFEs for drilling and, it's costing them $5-6 million to drill a well in a certain area, it's going to vary from area to area. But then when you look at the reserve report and on a per well basis, it's only $2.5-2 million. Well, that's a question that needs to be asked, why is the cost per well so low? And we usually do a severance tax analysis. This one's pretty straightforward. We usually just, get the severance tax rate the company uses in the reserve report and compare it to, what the actuals are, the actual rate. And just to note, each state has a different tax rate. So note that, note where most of the production's coming from. Make sure it's in line with the tax rate in that state, things like that. All right, moving on. The summary reserve report testing. Another thing we really need to look at, and what PCAOB and has been harping on is the company's ability to develop a 5-year plan for drilling PUDs. I think historically there's been issues around companies. They'll have PUDs on the reserve report and they just end up rolling them forward instead of, if they don't get drilled, well, they just roll those PUDs forward another year. There's still, no PUDs after 5 years, but it's the same wells that are not being developed. And I think that's an issue we've come across. So we need to make sure that these wells that they have for PUDs, they're actually developing year over year and not just rolling stuff forward and, carrying them on the reserve report. And obviously we need to make sure, like for an SEC reserve report, that they don't have PUDs over 5 years. We look at the analysis I discussed before. Do they have, is a company able to finance those PUDs? I've had it in the past in companies before they filed bankruptcy. They just had going concern issues and there was no evidence that they could fund these PUDs, so all the PUDs had to come off the reserve report, which created a huge impairment, changes the depletion and things like that. So it's just something you need to be aware of. There's no plan for the company to be able to develop those PUDs. They need to come off the reserve report. And also you want to look at the prior year development. If they only develop 10% of the wells, what's the probability of them reaching 100% development in the next 5 years? There might be a lot of explanations of that. Like 2020, for example, was a bad year for oil and gas. Well, bad year for everything, but a bad year for the oil and gas industry. So, a lot of the drilling ceased during 2020. So a lot of those PUDs were not being able to be developed. So there's explanations for a lot of it, but we just need to question those things. We may suggest for the client to provide a roll forward of the PUDs. This is a good way to do analysis to make sure everything's complete. You'll take the beginning reserves at the beginning of the year for PUDs. Then you'll take into account, new drilling, any acquisitions, the price changes and technical revisions during the reserve report, plus any PUDs that got transferred to PDP or any PUDs that dropped off the 5-year plan. And, they can perform a roll forward like that, and we can look at it bucket by bucket to see, where are the major changes coming from in the PUDs. And in the summary level testing, we'll also test look at the completeness of the reserve report. You'll take a sample selected, for our detail testing and compare that to the engineering data, make sure everything lines up there. Gather information on new wells and new discoveries to make sure they're being included in the reserve report. Compare the oil and gas activity. Of course, if the reserves and well count increases, you should see activity expected to increase. The same with ARO, increase in well count, increase in ARO. And you'll also want to look at the changes to unevaluated properties. If well count increases, then obviously our unevaluated properties should decrease because we're transferring costs from unevaluated to proved once those wells are being proved up.
All right, we're going to talk about some testing reminders and how to kind of sample for reserve report testing. So the first thing we want to do is kind of think through and document the nature of the test we're doing. So reserve report testing, primarily we're going to do sampling to look at a certain number of wells. And then we need to describe kind of the nature of that test and what we're trying to accomplish with that test in selecting those wells. The next thing we need to consider is just how many total wells the company has, as this has an impact on the overall testing strategy. If you kind of think about it, a company that owns 8,000 wells is going to require a very different testing strategy than a company with 1 or 2 wells. It's just, it's a lot kind of different situation. And from a detailed perspective, your summary and detail is going to be very similar, kind of the fewer wells the company has. We do want to consider higher value wells, as those would have a greater overall impact on the company's reserves. A lot of times you'll look at reserves and you'll look at kind of one-liner reserve reports and you'll see certain wells that are really kind of stand out compared to others and are really driving the overall value. So we want to make sure we look more closely at those, as those have a bigger impact on the overall results of our procedures and kind of implications on accounting. As far as sampling methodology, you want to document kind of the methodology that you selected to sample wells. There's a few different ways you can do it. An A40 is not typically an appropriate way of documenting the number of wells to select. I think an IPE form is probably the most common way to select the number of wells to look at. And then you want to make sure to just consider detail testing as part of the overall testing strategy. And you really need to kind of think through how to document and how to kind of correlate your detail testing in with the overall summary level testing and other procedures you've done to assess the value, the reserves. It kind of all needs to make sure we fit together and address the risks accordingly. One thing we do want to do is include a memo and document our procedures that we performed and what we determined was required for detail testing. Kind of the procedures that we've decided are important to do on a per well basis, whether those are our DOI tests, reserve decline tests, things like that, and document what risks those are addressing. And I think we do have an example memo somewhere floating around. As far as errors, differences, any discovered differences, you want to make sure to discuss with your clients. It's helpful to meet with the reserve engineers of the company and discuss kind of what from their perspective, what the rationale for things are. We may have differences, and sometimes those differences make sense and you can corroborate those with supporting documentation. And that's kind of the key thing, is you do want to make sure you can always corroborate any explanations you receive from your clients, and then make sure that our documentation accurately reflects both the client's explanation and the corroborative evidence that we received to justify their explanation. If we still have differences above our established thresholds and we're not able to corroborate, we need to quantify the impact of the differences on depletion and impairment. This can be kind of tricky to do sometimes, and it can result in some very big differences, or sometimes it can be relatively insignificant. So we just need to make sure to be able to address those and make sure we don't have any material misstatements there. One thing that I think is important to do is to kind of meet with your client up front and make sure, develop kind of what their expectations are. Make sure that that way, when you receive the reserve report, you can make sure that things are matching up with what their expectations are, and that kind of helps you from developing your expectations. I know a lot of my clients, we typically will meet with management, and the company's like third-party reserve engineers will sit in with like their meetings and kind of go through the reserve presentations so that we have a good understanding of what to expect. Detailed testing for third-party reserve reports. You kind of have to separate sort of third-party reserve reports from management reserve reports. Some things are the same. Some things the risks may be a little different depending on kind of who we're looking at and who prepared the reserve reports. So we'll go through a few things related to third parties. We need to also not only test the results that come from the third-party reserve engineers, we also need to test the data that is provided to those engineers. So from those data that's provided, you want to select a sample of wells based on the input risk assessment and perform different procedures for those inputs considered significant. And those can be, you want to consider the completeness of the population. You need to make sure that the data that's provided to the reserve engineers includes data for all of the wells, and that they're not leaving out some, let's say, unprofitable wells or something to make their reserves look better. You want to tie the selected wells to the accounting system to make sure that the data they've provided to the engineer actually does, in fact, match what's in their accounting system. You want to test the ownership percentages to the company's system and make sure the DOI that they've provided to their engineers matches the legal documentation. For each well you selected, you want to compare the 2022 estimated production for the reserve report to the actual 2021 production. You want to detailed test the lease operating expenses back to the accounting system, calculate the average price received on the selected wells as production. And the company may have different wells in slightly different areas, and they all could receive slightly different prices. You want to compare the actual prices received to the spot prices, so you can calculate an average differential. Then detailed test the differential to the prior year actual differential on a well-by-well basis. Then the other thing you want to do is test from the accounting system to the engineered data. So we'll select wells from the accounting system and trace those to the engineering data. You want to tie the total number of wells from the accounting system to the engineered data. So from a completeness standpoint, one thing you always want to make sure is to look at wells from other sources. So like you could look at wells that have generated revenue during the year, and then you want to tie those to the reserve report, make sure that the wells are included within the reserve report. Or you can look at other things like ARO calculations. You can look at expense side. If a well has incurred expenses, then make sure it's on the reserve report. There's a lot of different procedures you can do, but the fundamental principle is we want to make sure the reserve report is complete and includes all of the wells. Sometimes clients will prepare a reconciliation from the accounting system to the engineering data. You want to obtain that for purposes of tying up the wells to the system and the engineering data. One thing we do want to do is always make sure we receive the reserve engineer confirmation. This is an important piece to assess the qualifications of management's experts. Management's reserve engineer would be considered a management expert. And we want to make sure we confirm the methods they utilize, the key assumptions they utilize, their experience, and their certification. One thing I would definitely recommend is if they return a confirmation that says they're a licensed engineer in the state of Texas or whatever state they're in, you can generally log on to the state licensing websites and verify that their certification is accurate and is current. Okay, so detailed testing on internally produced reserves. From the reserve report, you want to select a sample of the wells based on input risks. And this kind of the key thing here is make sure that all of our procedures we're performing directly correlate to the risks that we've identified. Any inputs that we've considered a significant risk, you want to tie the selected wells to the accounting system, tie the ownership to the system to the division of interest or other legal documents. For each selected well, we want to compare the estimated production for the reserve report to the 2021 actual production. We want to detail test the least operating expenses back to the accounting system, calculate average prices received on the selected wells, calculate actual prices, and compare those to the spot prices to calculated average differential. We want to detail test the differential and make sure that's similar to the prior year actual differential. And sometimes you'll see changes, but you want to make sure that you can justify and have a good explanation as to why those changes are occurring. Like, for example, your client could sign a new revenue contract that reduces the differential from a minus $1.50 per barrel to a minus $1.25 per barrel, and you would have good justification then for that change in the reserve report. The confirmation, you want to perform a similar confirmation process for an internal reserve engineer. You still want to make sure that their methods are considered reasonable. You want to confirm the key assumptions they use to make sure they use the correct pricing, make sure they use the correct discount rate, etc. You want to verify that they do, in fact, have an appropriate level of experience to be able to perform those reserve reports. We don't want a financial accounting person preparing a reserve report, as it's more of an engineering function than an accounting function. And then same thing, certification. Make sure that they have some sort of certification to indicate that they're properly qualified to be preparing the reserve reports. Then from the accounting system, we want to select wells from the accounting system, trace to the reserve report. Then you want to tie the total number of wells from the accounting system to the reserve report. Again, this is primarily a completeness step. We're just trying to verify that the reserve report does in fact include all of the wells that the company owns. And the reason there could be errors involved. There could be a company trying to exclude certain wells that are not producing as well as others. So the next thing we want to talk through is some SEC regulations and then some comment letter examples and discussions. So Regulation SK is to inform investors as to the suitability, adequacy, productive capacity, and extent of utilization of the facilities of the registrant. We want to understand the reserve controls by the company is an important disclosure for investors. Therefore, the SEC has specific guidelines, and those are related to the SEC case reserves primarily, and then you're going to disclose those in what's called SMOG, which is Standardized Measure of Oil and Gas. Financial accounting and reporting for oil and gas producing activities is also described by SEC guidelines. You can look at those specific sections, which are the useful definitions. And the other thing that's important to remember is full cost is actually described within the SEC regulations, not GAAP. There's a piece in GAAP that actually refers to the SEC regulations for full cost accounting. But those are the rules that govern all full cost companies, private or public. Then some SEC comment letters. This is one we received, which was pursuant to Rule 410A26 of Regulation SX. The recognition of reserves requires a reasonable expectation that necessary financing exists. Please tell us how the $2.4 billion increase in your debt balance and the resulting change to interest expense, along with your stated goal of reducing leverage during the next few years, is expected to impact your ability to fund the development of your PUDs. A lot of times, this is one of the issues that you'll come across in reserve reports, is whether the company can actually fund the development of those PUDs. And this is a very important piece because, as you can see, there's been some SEC comment letters that have come out in the past. So we always have to make sure, if the company tells us they plan to spend $100 million over the next 5 years developing their properties, that they are actually capable of developing those properties and spending that $100 million over the next 5 years. There's another SEC comment letter that was received, which is, they noted that approximately 9.5%, 8.4%, 4.3% of PUDs respectively. Disclosure in the Form 10-K states that in the near term, you'll focus on maximizing returns on existing assets by deploying capital resources on lower risk development drilling in the fields where you have previously enjoyed success. Then the SEC wanted the company to explain how this capital resource plan will impact your ability to convert PUDs to proved developed status in a timely manner, especially considering that you converted less than 10% of your PUDs in each of the last 3 fiscal years. So one procedure we would want to do to make sure we've addressed this comment letter and prevent this comment letter in future years is to evaluate the company's historical ability to convert PUDs to PDPs. So if the company has historically not been converting those PUDs to PDPs, it may be maybe a situation where we need to rethink kind of whether those make sense to be carried as PUDs. There's another one here, talks about how the company plans to convert 16% of proved undeveloped reserves to proved status in 2013. However, they converted approximately 0.8 MMBOE or 2% of the PUDs during 2013. Then they want them to explain what caused this change in the development plan and then provide them with an updated schedule showing the development plan, along with a description of significant changes compared to the information you provided previously. And then the procedures we could perform to ensure this comment letter doesn't happen in future years is to understand the client's development plan by speaking with those outside accounting, such as reservoir engineers, geologists, and land personnel, and then do their explanations agree with the projections on the reserve report. And then the last one is, please revise your disclosure of proved reserve quantities to include an explanation of significant changes that occurred during the periods presented. And they want the company to refer to FASB ASC 932-235-50-5 and provide a column for the total quantities of proved reserves for all products as shown in ASC 932-235-55-2. The procedures that BDO should perform to address this comment letter are to perform a roll forward of reserves from year over year and obtain explanation for the changes. These are required per 932-235-55.
All right. I'm just going to walk through. First thing we're going to do is walk through a reserve report and just kind of how to read it. I know a lot of you have looked at these already, but for anybody that's new, I'll just kind of, go through a summary level reserve report just to show you what they look like and how to read them. So on this reserve report, it's obviously produced by W.D. Von Gotten, and this was from prior year, so it goes through 21, 22, going forward. On these first columns, this is going to be your 8/8 production, so that's 100% production that's coming out of the wellhead. Then it moves on. It'll take into account the company's net revenue interest, and this will be the company's net production that they use for sales. So these are generally the amounts that we need to be comparing to when we're comparing to actuals, because this is what the actuals the company owns, these right here. This is what the company owns. Moving forward, so it reads from left to right, and down here, it'll take into account the pricing. as being utilized. So generally on a summary level test, we'll take this bottom number. This is for the total proved amount, and compare that to the pricing and then the differentials used. I'll show you all how to do that in the testing summary. And then these volumes times the pricing obviously get you to the net revenue for the company right here. That'll show you the total revenue for the company in the reserve report for total proved. Then it starts deducting the cost. So you have your state ad valorem here, and then you'll have your local severance tax, which reduces your revenues. You come down here, you have your LOE, and this is where the direct plus the variable cost comes in. So you'll have your direct, LOE cost, and then they'll include a LOE per BOE cost right here. And you'll get like a total expenditures right here. They'll also drop in the net capital. So this is the capital, usually your drilling cost or any capital intensive costs that are going to go into the wells. And then that gets you out to your future annual revenue. Then they'll take the 10% discount. This is for an SEC reserve report. And right here at the bottom, at the end, it'll give you your PV10 value. So that's, the PV10, like on a management's best estimate report, we compared to their cost to see if they're in an impairment position or not. So this is just an example of a reserve report. This is your total proved, and then if you move down, scroll down, this is your PDPs. This is your PDMPs. This will show your PUD summary. And you'll see most of the capital is in the PUDs right here. And then you'll have like a total proved amount for an SEC reserve report. So it's all the same stuff. It's just broken out into different categories. All right, moving on to the summary level testing. So on our summary level testing, this is a template that everybody pretty much uses on most jobs. It kind of varies by company to company. Of course, it's going to be modified for each client depending on what they're doing. But this is a general template everybody uses. The first thing to do, this first tab just kind of talks about the procedures we'll be performing like we went over in the slides. First thing to do, though, on this template is to come in here and copy all the information over from this reserve report. So once you do that, you can see, it's pretty much lined up just exactly like the reserve report is. Once you do that, all this information will flow into these tabs. So this kind of helps out and expedites the process a little bit. And so moving on to the pricing test, and this is going to be like one of the first tabs you want to start with. All this does is it compares our pricing to the market pricing compared to the SEC pricing on average. Then you'll take the pricing in the reserve report and the pricing for the LOS, and it creates a differential. Or, it shows you the differential. So this is the differential used in the reserve report, and this is the differential the client has based on, this client uses the LOS to calculate it. So we did the same thing. We got a 4-cent difference, which we consider to be reasonable. Do the same thing with gas. We got a 4-cent difference, which we consider to be reasonable. Each team is going to be able to see, develop their own expectations and know what differences are going to be material. So this will vary from client by client, but in this case, we consider those differences to be reasonable. Next thing will be is looking at the discount rates. When we look at the discount rates, we just take the overall undiscounted cash flows, which comes from this tab when we copy it all over. And there's a calculation in here that's already in here. It's just a present value calculation for the discount periods. This is pretty straightforward. It should automatically pretty much calculate this. You want to make sure that you're using the right discount rate if you're using a managed best estimate reserve. But for this SEC pricing, it's 10%. So, it came down here, it calculated it out. Then we compared it to what's on the reserve report. We had a 430 difference. You're going to see differences in this. You would think it calculates straight out, but as wells fall off, they don't fall off at the end of the year. They'll fall off, during the year. So, as a summary level test, this is calculating everything for the whole year for each one of these lines. So it's going to create some difference, but it should be pretty minimal. Again, each team's going to have to develop their own expectations on what differences are going to be considered material. All right, moving on to decline rates. This should populate from your reserves on this tab. And when we were talking about decline rates going through the slides, this is a pretty normal decline rate. Each company is going to be a little different depending on how they operate. A lot of companies will pull on the wells a little harder at the beginning of life. They're trying to get as much initial production out of the well as possible to, get as much cash flow through the door early in the stage of the well. So, you might see a sharp decline curve and the declines will level off as those wells, lose volume and they'll start leveling off. But this is a pretty decent normal decline curve. You just want to make sure they're all pretty consistent and you don't have any spikes, or, the production starts increasing. You need to have explanation for all that on these PDP declines. PDMPs are going to be a little different just because these PDMPs are, these are wells that are drilled, not producing. So they might, they brought these wells online right here, but then they started declining. But then later in life, these other wells come online, so it spikes up. We just need to have an explanation from the reserve engineers what's going on here. We see some CapEx coming in. What's up with this large spike out here? And, generally this is just, these PDMPs have low reserves quantities, so you're going to see large spikes when anything starts coming online later in life, like right here. And then PUDs, as we discussed, they have their 5-year plan here, and it goes out 4 years. So we just want to make sure, obviously production increased through those 5 years as they're drilling and bringing new wells online. But then after that, you see a steady decline, which is pretty consistent. They're what we expect. This OPEX testing, this is where your LOE per BOE is going to happen. All this should pre-populate. And you'll take your LOE per BOE from your LOS, as in right here. This is your production. This is the BOE. This is your total LOE. And you'll calculate out a rate, and you compare it to the rate in the reserve report. And any differences need to be explained that are over your threshold. We'll also graph these out, and you'll see this is a pretty consistent increase per LOE per BOE. You'll see this over the life of the wells, just due to wells declining in volume, and they always have that fixed cost involved with LOE. So, as the production goes down, that fixed cost stays constant. So your LOE per BOE is always going to increase over the life of the wells, generally. And these are just more graphs that we look at on a total basis. Then you look at your severance tax rates. You'll compare those, make sure they're within a certain range, which the team deems reasonable. Then you'll go to looking at your capital cost. You look at it per well, PUDs per well. You'll look at it in total. All this should populate for the total number of wells, total cost. And right here you can see where, we said they had a line of credit, $294 million. They needed $64 million to, plus they had capital available. They needed $64 million to drill, so they had a cushion of $261 million, which is obviously enough to keep these PUDs on the reserve report. So with that, that's just a brief overview of this.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Alright folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.